You know that gut punch when your portfolio tanks? Sarah felt it in March 2020. $50,000 down to $25,000 in 3 weeks. Most investors think they're safe with stocks, ETFs, and bonds. Wrong. Without the right structure, you're gambling. In this video, I'll reveal the 3 fund system I use for every client: growth, global, and stability. It's not theory, it's crushed the market for 50 years. Quick disclaimer: past performance is not indicative of future results. Investing involves risk, including loss of principal. This is not personalized financial advice. Consult a licensed advisor. First, let's ignite the growth engine. Meet the growth engine, the part of your portfolio that actually makes money while you sleep. Think of your growth engine as the rocket thruster. Without it, your portfolio never leaves the launch pad. It's the broad market, low-cost portion of your portfolio. Funds or ETFs that capture your home market's overall performance, for example, VTI or VOO in the US, IWDA or VWCE in Europe, or your local total market equivalent wherever you are. This is the engine that grows your money over decades. Look at the numbers. Over the past 40 years, broad equity markets have averaged roughly 10% annual returns. That means $10,000 invested 40 years ago would have grown to more than $500,000 today. Here's the part people miss. The growth engine isn't about trying to pick the next hot stock. It's about consistent, broad market exposure. Your job is to fuel it, not babysit it. And your allocation matters. Too little and you leave growth on the table. Too much without risk control, and you're setting yourself up for panic. Next, we'll talk about the allocation that makes this engine work, and why most people get it wrong. How much of your portfolio should ride this growth engine without you losing sleep at night? Here's the thing. The growth engine should be the largest part of your risk assets, typically 60 to 80%, depending on your age and risk tolerance. Let me give you a story. Jake, 28, had 40% in growth stocks and 60% in bonds because he was playing it safe. Meanwhile, his friend Mia had 75% in growth and 25% in bonds. Over 10 years, Mia's portfolio doubled Jake's, because she leaned into growth when she could afford to. But there's a catch. Allocation alone isn't enough. You need discipline. If the market dips 30%, panic selling kills returns. That's why this section isn't just about numbers. It's about making your portfolio behave like a rocket, not a roller coaster. With your growth engine set, it's time to expand your view. Enter the global engine. The global engine is all about capturing growth that your home market can't give you. Even the best home market portfolio is limited. This part of your portfolio gives you exposure to markets beyond your home country, through international or world equity ETFs. For example, VXUS for US investors, or VWCE and IWDA for investors in Europe. Quick clarification. If you already hold VWCE or IWDA in your growth engine, you technically already have global exposure. The key is to make sure your portfolio isn't overly concentrated in one market, whether US, Europe, or your home country. You can adjust your allocation so your growth engine drives your domestic growth, while the global engine smooths out volatility with truly international exposure. Typically, the global engine represents 10 to 30% of your risk assets. Why bother? Because different markets move differently. When one region dips, another can rise or hold steady. Between 2010 and 2020, global markets outside the US still returned around 9% annually, and they often offset US declines. That makes the global engine a powerful form of insurance for your growth engine while still delivering growth potential. It's not optional. It's essential. Next, we'll talk about the third engine, the one that keeps you from losing sleep during crashes. Growth and global engines get all the glory, but the stability engine is what actually protects your portfolio when things go south. Think of it as your seatbelt. You don't want it flashy, but you'll be glad it's there. Typically, this is high-quality bonds or fixed income ETFs. Americans often use BND, total bond market, while those in Europe can go with a global bond ETF. Here's the impact. During the 2008 financial crisis, the S&P 500 dropped roughly 57%. A portfolio with 70% stocks and 30% bonds lost around 35 to 40% instead. Still painful, but far less catastrophic. That's the cushioning effect. Your stability engine doesn't make huge gains, but it prevents massive losses, keeps your portfolio steady, and lets you sleep at night. With all three engines defined, the next step is how to combine them into a real portfolio that actually works. Here's a simple, proven approach on how to mix growth, global, and stability so your portfolio behaves like a well-oiled machine. Young investors, 20 to 35 years, 80% growth, 15% global, 5% stability. Mid-career, 35 to 50 years, 65% growth, 20% global, 15% stability. Near retirement, 50 plus 50% growth, 25% global, 25% stability. The key is balance. Too much growth without stability, and one market crash can erase years of gains. Too much stability, and your portfolio grows too slowly to beat inflation. Now that you have the mix, the trick most investors miss is simple. Rebalance once a year. Just reset to your targets and let the markets keep it running smoothly. Now let's talk about rebalancing. The portfolio habit that separates amateurs from pros. Markets move all the time. Growth might surge from 70% to 80%. Risk might shrink from 10% to 5%. Without action, your portfolio is off-kilter, and you're either taking too much risk or missing opportunity. Rebalancing is simple. 1. Review your portfolio annually. 2. Sell a portion of funds that have grown above target. 3. Buy more of funds that are under target. A study by Vanguard found that annual rebalancing improved risk-adjusted returns by 0.5% per year. Small number, but over decades, it's tens of thousands of dollars. Next, we're going to address the sneaky behaviors that silently destroy portfolios and how to avoid them. Here's the reality. Most people ruin good portfolios with bad behavior, not bad markets. Panic selling during dips, chasing trends like crypto or hot tech stocks, constantly switching funds. During the 2021 meme stock craze, an investor moved 50% of his portfolio into a single stock. By mid-2022, he'd lost nearly half of it. Meanwhile, his three-fund portfolio quietly grew as expected. The lesson? Stick to your engines. Ignore the noise. Let your portfolio do the heavy lifting. Let's bring everything together. If you had taken the three engines, your growth engine, your global engine, and your security engine, and invested them from day one in an 80-15-5 mix, here's what actually happened in the real world. No theories, no guesses, just the market telling you the truth. Here's what $10,000 actually grew into over a full decade. Invested in an 80% US total stock, 15% international, and 5% total bond portfolio starting in 2010, grew to about $52,000 by 2020. Remove the global engine. Keep it 95% US total stock and 5% bonds, only $48,000. Now, the real test, the 2020 market crash. When COVID hit and stocks plunged in March 2020, the 80-15-5 portfolio mix dropped roughly 28%, a sharp but short-lived hit. A 100% US stock portfolio fell 34%, over a third wiped out in weeks. The balanced mix recovered faster and lost less. This isn't theory. It works. Your next move? Start today. Automate monthly contributions. Rebalance once a year. Ignore the noise. Take action now. Decide your split. Comment your plan below. Hit like, subscribe, and turn on notifications. Thanks for watching. Now go fire up your three engines.